Hey, everybody, welcome to Charts and Coffee. Happy Friday, everybody. Just really excited. We've got our Simpler Circle event. So we'll be going on for about 20 minutes before that event begins. So great to have you here. Of course, the whole point, if you've never attended a Charts and Coffee show before, we are here at the Simpler Trading YouTube channel, Monday through Friday, 9 to 9:20, answering your questions, getting ready for the day. And today, getting ready means what has happened with that PCE. Remember, this is an inflation number and the Federal Reserve's favorite inflation number. It's a little pet inflation number. And they watch it, and it came in line. So the core PCE, which excludes things, don't even get me started on the lunacy of these inflation numbers, especially the PCE. But the core number came in as expected, which is not necessarily a ratcheting up of inflation. And of course, what do stonks like about that? What you'll see is the equities are rallying because the number wasn't as hot. Not surprising. Now, that's the 5-minute chart you'll see here. I was really looking for, we got very close, achingly close to what I call a first come, first serve fade. You might say, Rog, what is that? That is waiting for a high impact hot zone like the PCE to be released and seeing if prices trade down into volatility based support. And you can see how close we got, and then it launched higher. So this is where we sit at the moment. We're going to probably see an echo of this. That's the effect. 8:30 hot zones tend to echo into 9:30, the open. And then we'll see what we get as we go into what is, a 3-day holiday weekend. And remember this, and I put this in the free video yesterday. So it's pretty important in terms of not, look, there's a squiggly little line between patience and denial. And the way you stay on the right side of that is by always having a process and always having a way by which to assess the underlying market trend. And whether this be the S&P, whether this be the Nasdaq or the Dow, we are still in a downtrend. The Nasdaq is making it to the 21 propulsion, which is my replacement for the 21 exponential. This is a tool that allows you to put what's really a self-correcting smart EMA on your chart. By the way, completely gratis. You can find it over at countdowntrader.com. You can download it for Thinkorswim. It's available in the TradeStation trading app store. It's also available on the TradingView platform, which is the one that I'm on here with you today. So pretty exciting stuff by way of, and exciting because we're getting corrections of the downtrend that we've been waiting on for some time. And that's what I'll continue to focus on. The fact that the markets are still overall in a downtrend, the Nasdaq being the weakest, S&P second weakest, and from a relative performance standpoint, the Dow is the least weak. All right. So as always, gang, this show is about your questions. All right. And let's go ahead and jump into, those questions. Kicking it off, Mr. Walker. Good to see you all, one of our longtime Charts and Coffee folks. When day trading, are 21 and 34 exponential moving averages valid support or resistance on the 5-minute? Yes. And this is a really easy answer, but only in the context of the trend. And for me, only within the context of whether or not my propulsion dots are lit up. Okay, Rog, that's a mouthful. For those of you that are new to my process, what does that mean? Well, this is an uptrend. I can see by the structure of the market. Really easy. By the way, I've got 4 rows here. The first row is the S&P. The bottom row is a relative comparison choice. You can choose to use that. You can choose not to. But I just have this running right now because relative performance is always a key part of my watch list building for the Sector Secrets Mastery, for anything I do in this Simpler Options room or anything I do in the Simpler Futures room. And yes, it applies to day trading as well. So take a look, Mr. Walker. Only when we're in an uptrend, and take a look. My propulsion dots are lit up. Boom, 13. Boom, 21. Look at that follow through. Do you see that, how it nailed the dot and up it went? That's what we're looking for. Okay. Now, um, this approach in terms of trend following, remember, gang, moving averages are only really valid, as far as I'm concerned, as dynamic support or resistance within the context of a trend. So keep that in mind across any time frame you are setting up a trade. All right, Aircon Gypsy, how are you? Thinkorswim is down for many on the East Coast. Oh, okay. I hope this helps others. Okay, very cool. You know, it just reminds me, and thank you, Gypsy, for reminding me. Our community, and awesome. Thank you very much. When I log into any of the rooms and the members are saying, hey guys, I'm having some issues here, or this symbol needs to be whitelisted on this platform, or heads up for this. That's one of the reasons we don't want to trade alone, right? We have not only, I'm grateful and honored to be a trader and be able to be on the mic and share ideas with you all, share what I see. But then the community really kicks in, and you've got hundreds and hundreds of members who are looking at similar things with similar tools, all supporting each other. And Gypsy, thanks for that. Absolutely. Same thing, Bill. Okay, cool. By the way, this is why I have backups. I think there's a value of redundancy. Any broker could have that kind of day. And that's why I love the redundancy of having, a backup platform, whether that be TradeStation to Toss or Toss to my TradingView or TradingView to Toss. I'll usually have 2 or 3 platforms ready to go. All right, next up is Alan. Let's see, gold and silver running together. Silver's pulling back from a ledge in the wave. I am not a big fan of looking at silver and gold necessarily in the same light. Now, all my cards on the table, we do have that short position via long puts or short micro gold or short gold futures right now. And it's on track. It's not falling at the speed I'd like it to fall, but I think we're on track with a valid market structure. But silver, remember, silver is in the middle of copper and of gold. And most of the time, I'd rather be in copper or gold. Copper is in a downtrend right now. Gold is in a downtrend right now. Is silver in a downtrend? It is. Silver can be a wild ride, much like natural gas. So I'm going to focus usually on SLV options, Alan, or SI options. Can you short silver? The structure's there, right? Red grab candles, bearish momentum, bearish trend by way of our trade flags, or our multi-trend, steady string of red grab candles. So yes, I'm absolutely open to a potential short, but I'll probably focus on gold and copper because silver is a little bit like gold. It's not as sensitive to real yields, and it's a little bit like copper. It's not quite as sensitive to economic optimism and quite as entrenched in that industrial type application. It's a little bit of both. So I'll rather go to one or the other, but silver, yes, to your point, it does have structure validating itself. All right, so next up, hey there, Protkiss, PCE, we mentioned came in line, expectations were for 0.3. We got the 0.3, which is quote unquote good news, right? Because inflation was not hotter than expected, not hotter than anticipated. So with that in mind, the equity markets are going to say, oh, terrific. The Federal Reserve has no reason to ratchet up an already fairly aggressive tightening policy. What does that mean? In June, we're going to see a half-point hike. In July, we're going to see a half-point hike in terms of what the Fed Fund Futures contract is projecting. If you're watching television or reading something on the internet and someone starts giving the percentage probabilities, that's where they're getting it from, the Fed Fund Future. So that's where I'm pulling my opinion from as well. So we're going to see probably a full 1% between the next 2 meetings hike. And as we go into September, we're still looking at another 25 basis point hike. So this is a Federal Reserve that's still pretty dedicated to raising rates. And yeah, maybe the PCE gives some traders a sigh of relief. I believe we're looking at, relatively speaking, fairly low volume. We're going into the holiday weekend. There's been conversation about less concern about inflation. That's what the headlines have been really dominated by. So not surprising to see that this still being a retracement of the downtrend is a little bit stronger. But notice we haven't even topped out the last retracement that peaked on May 18. We haven't even exceeded that high, right? So if measuring what's next is also a process of measuring what's new, nothing's new. We're still looking at a market that put in a lower low and has yet to take out even that higher high. And even if it does, we're still within the context of a downtrend. So say the 8, 13, 21, 34 EMAs. All right. So that's what we've got going on there. Thanks for the question. All right. Next up is, do I have any thoughts on DBC? Let's see what we have here. DBC. So this is essentially like the S&P 500 of commodities. This is still a valid buy the dip. Yeah, this is a valid buy the dip. We've had some more extreme type dips, but I would focus, Ronaldo, I would focus on the long side. Yep, I would absolutely say this is still a double green. So a lot of folks say, well, buy the dip is dead. No, it's just that we have fewer uptrends. So if you have a process by which to recognize, confirm visually uptrends, and by the way, we have a couple tools for this. If you're a member within the simpler community of the day trading room, the options room, the futures room, or the sector secrets mastery room, and I think we might even have this for members in our trading room. There's a layout in the room drive, which you can go download, that includes my wave, grab, propulsion, and what I call the trade flags. And you can see them on this chart down here, because I'm on trading view, so it looks a little bit different. And it is showing me green momentum, green trend, 8, 13, 21 momentum, add the 34 trend. I've got to read both on the momentum and the trend, color coded, traffic light simple. I see green over green. I see a consistency of green grab, GRAB candles. Again, all of these were included in the layout. Most of these are available over at countdowntrader.com. I'm going to buy the dip, gang. Buy the dip is alive and well, but just in a much smaller group of symbols than it was, say, in 2021 or even 2020. All right, next up, does the Nasdaq have more room to climb? So let me address this. So yesterday in the video, I said always process over prediction. What is prediction? Well, turn on television and you'll see a bunch of chuckleheads telling you where the markets are going to go. Wow, what an amazing skill. I don't know if they have a DeLorean with a flux capacitor in it and they're able to zoom off into the future and they know where the markets are going to go. I know myself, 32 years in, I've never been able to see the future. What a wonderful skill all those folks have. For the rest of us mere mortals, we stick with process. We don't go into prediction. If we're in a downtrend and we have a process by which we look at where resistance could be, what are those resistance levels? We usually start at the first string of propulsion dots. And you'll see I've got the green ones there. That's the 21. Very popular level to consider kind of an aggressive retracement, right? That's a aggressive level, but a legit retracement where we could consider a aggressively position size, smaller position size entry. But for me, then it goes into the wave. So I've got the 21 propulsion here. Then I've got the actual wave, which is the 34 EMA on the high, the close, and the low. As I travel up into that area, which, by the way, we did here, right? So we travel up into that area. I will continue to look for, as long as we're mostly red over red, as long as we still have the 8, 13, 21 confirming the downtrend, I'll look for long QQQ puts. I'll look for long NQ puts. Now, a lot of folks are asking, Rog, but we're rallying right now. Summertime is the time for, I believe, especially the market we're in right now. Every summer, I start to day trade. Every summer, I shorten the time frame so that when we're in sort of the relative illiquidity of the summer months, as they say, and they've been saying for years, decades even, the money goes to the Hamptons. That's really, by the way, where sell May and go away came from. that not that it's a bearish time necessarily or a bearish season, but rather the liquidity, the participation goes and hangs out in the Hamptons. So if I'm dealing with lower volume, potentially lower volatility, lower liquidity, one of the easiest ways to get follow through, which is what all of us traders are looking for, follow through, is to shorten the time frame. And instead of looking for follow through day after day, week after week, I just need follow through maybe for an hour, for two, maybe for that session. And that's it. And I get to start the next day over with a clean slate. It's not about in and out, in and out, in and out, right? It's not about hyperactivity. It's about shortening the time frame and saying, you know what, I don't want to have to need to see longer term organization, longer term follow through. So if we have bullishness, we'll day trade it. We'll look for opportunities to take advantage of, say, a 5-minute time frame and day trade it. So that's what's so cool about that. All right. So does the Nasdaq have more room to climb? Yeah, I think it certainly could. It's certainly good. It's at the 21. We still have the wave overhead. But if I want to take advantage of the climb, I'll do so in a shorter term time frame. And as I keep that trend following, short the rally, short the retracement tactic in mind, that's applied to the daily. Don't be afraid, be open to having a different directional bias on two distinctly different time frames, which have, of course, two distinctly different time horizons. All right. Thanks for the question, day trading. All right, next up, do I ever look at the expected move? Ray, I look at volatility. So it's just another way of measuring what's expected. So this is my expected move. I do this on the hourly, which I call the HPMR, and I also do it on a daily, which is called the DPMR, hourly price movement range and daily price movement range. So I look at historical volatility 6 months back of this sort of rhythm, the psychology of rhythm. And so I look at it, the simple answer is yes, but the more complicated answer is I'm looking at probability from a historical standpoint. So think of it this way. Most options expected moves, I believe that there's a slight flaw in that, in that the way that they're measured, if we have a sudden expansion of volatility, implied volatility, expected volatility, the percentiles, they don't contract to reflect that once that has expanded, well, maybe it's starting to contract. What happens is it's much like a sweater that you've stretched out. Do you ever try to bring a sweater back to its original form? It usually doesn't happen, or it takes forever, right? Volatility in that, the common one that options traders use, we have a sudden burst of volatility, it doesn't react as snappy as we might need it to. It sets to that wide size, which then skews really the remainder of the volatility because the measuring stick is kind of off. I hope that makes sense. Historical volatility doesn't do that. By the way, neither does average true range. So I prefer the PMR, the historical volatility, and that's what I'll use as far as expectation of range, both intraday and end of day. And one of the cool things about PMRs is I can do this hour to hour intraday, which is something that really nothing else can do, which is why I favor that, especially for day trading. And that's why I have those zones on my screen. Thank you for the question, Ray. All right, next up, I was playing DHI. Sure. And I realized something. I didn't resize my my screen in such a way that y'all can see the bottom of my chart. And I don't know, it's not letting me resize it. It's going to be in a pain. Sorry about that. I know you all can't see the bottom of my screen, but we'll fix that for Sunday. Sorry about that. Just realized the bottom is cut off by the questions. There we go. All right. So the question now is about DHI. Sure. Now you can see the bottom of the screen. So I'm in DHI. And we've had a significant rally. DHI is one of the best downtrends within that ITB XHB group. This is where I will say, always know your risk, always know how to scale in. One of the things that we teach, I'm going to leave you with this, and then everyone's going to head on over to the simpler circle. Think about a scalable mindset. It's not about large account. It's not about small account, because newsflash, we trade them both the same. I've traded both 4-figure and 7-figure accounts. It's a scalable mindset. It's looking at your account size, determining the risk that's appropriate for it, and scaling in according to that. I've been trading large accounts in the same way that I trade smaller, only the contract number changes. Okay. All right, gang. I'll see you all in the Simpler Circle room. I'll be in there at 11:30. Have a great, great day. Enjoy the long weekend. And I will see you all after Memorial Day. And again, take care. Be good to each other.